What's up, everybody? Welcome to the Wealth Game Nation. My name is Vedo, and I'm here to help you better understand the Wealth Game and become part of the Wealth Game Nation. In this video, I will be reviewing my top 5 stock picks for the year 2024, and by looking at the discounted cash flow analysis, I will be explaining why I believe that these 5 stock picks will be outperforming the overall stock market in 2024. So let's get right into it. Coming in at number 5 is Canadian Pacific Kansas City Railway. It has been a rough ride, pun intended, for the majority of the railroad companies in North America. CP has positioned itself great for 2024 after 2 years of intensive reinvestments into the services of the railroads. One major catalyst for CP is the merger with Kansas City Railway. With this merger, CP railways go from Canada all across the United States and all the way into Mexico. With the majority of the companies now doing a so-called onshoring, meaning moving their operations from overseas due to major world conflicts close to their own borders, CP has set itself up for great success in 2024. On top of that, railroads have a high barrier to entry for its competitors. They are by far the most efficient type of transportation, and I do not see this changing anytime soon. Now, let us take a look at some metrics for CP. As you can see, CP has been trading flat for the whole 2023 year. Year to date, it is barely up. Next thing we can look at is the price to earnings ratio. CP has currently a 23.45 PE, which gives us an earnings yield of 4.26%. Then the dividend is at 0.72% or $0.76 per share. The payout ratio is also low, below 17%. Last but not least, the price to free cash flow is at 44.75, which gives us a free cash flow yield of 2.23%. Now, let's take a look at the valuation of CP. For this, we will use a discounted cash flow calculator and we will use the metric of earnings. The numbers of years to project will be 5 years. The earnings growth rate for the past 5 years has been 16.43 for CP. The shares outstanding growth rate for the last 5 years has been at 5.6%. However, the management at the last earnings call said that this will not be the case anymore in the future, so I am making an assumption of 0.5% shares outstanding growth rate. Price to earnings for the past 5 years has been 22.93, and that's the price ratio we will use for this calculation. The discount rate is 10% because we are comparing to the average growth rate of the stock market, which is at 10%. Then, once all this data is plugged in, we can see that the fair value of CP per share is at $133, which is about 26% above the current price. If CP can hit all these metrics, then the future price of CP per share will be $214, or 103% above the current price, which is a 15.26% compounded annual growth rate. Next, coming in at number 4 is Alibaba. This stock has been absolutely clobbered in the stock market over the last few years. Peter Lynch, my favorite investor / comedian, once shared a lesson with us all on the trap of thinking along the lines, how low can the stock price go? But seriously, in this case of Alibaba, how low can it really go? I know the answer is 0, but Peter Lynch also said that it's very difficult to bankrupt a company if you have 0 debt and you have a strong balance sheet. And Alibaba does have a strong balance sheet and very low debt. I mean, seriously, all metrics of this company are positive, yet the share price keeps going down. Major contributor to the stock price going down is the China-US relation, and this risk is not to be underestimated. Now, let's take a look at some metrics for Alibaba. As you can see here, Alibaba has been trading down for the whole 2023. Year to date, the stock price is down by 18%. Alibaba is trading at a very low PE of 10, and the forward PE is even lower at 7.6. This PE gives us an earnings yield of 9.7%. The dividend yield is at 1.33% or $1 per share. The payout ratio is also very low at 13.7%. Last but not least, the price to free cash flow is at 6.4, which gives us an astonishing free cash flow yield of 15.6%. Benjamin Graham, the grandfather of value investing, has come up with a so-called risk premium ratio. This is where he compares an earnings yield or a free cash flow yield and compares it to a 10-year bond yield. The difference between a bond yield and the earnings yield of a company is what he calls the margin of safety. And the bigger the margin of safety is, on paper, the better of a deal you are getting on that company. Currently, the bond yield on a 10-year government bond is at 4%, and as we can see, free cash flow yield is at almost 16%. And if you've seen the valuation of other companies in the market, then you will know that this is a very high free cash flow yield and therefore a big margin of safety. Now, let us look at a discounted cash flow analysis for Alibaba. Here, we will use a metric of free cash flow. We will project a number of years to 5 years. We will take the annual free cash flow growth rate over the past 5 years, which is a 16.23%. We will also take the shares outstanding growth rate, which was the growth rate for the past 5 years and is at minus 0.37%. This means that Alibaba is buying back shares. For the price ratio, we will also take the average of the last 5 years, which is at 21.42%. However, we saw that right now the price ratio is even lower. Again, the discount rate stays at 10%. And then if we take all those metrics into account, then we can see that the fair value of Alibaba per share is at $336 or 347% above the current trading price. If Alibaba just keeps on the same metrics as it was for the last 5 years, then the future stock price would be at $542 or 620% above the current trading price. This would give us a compounded annual growth rate of 48%. Obviously, there's a huge discrepancy what the fundamentals of Alibaba show and what the price of Alibaba shows. This is where the other macroeconomic factors come into play, such as the conflict between US and China. However, in my opinion, 48.5% compounded annual growth rate would be insane. And even if you apply 30, 40, 50% margin of safety, you will still be looking at a 24% compounded annual growth rate, where the average of the stock market has been returning 10%. If this happens, this would be a massive outperformance. Next, coming in at number 3 is Alphabet. I see at least 2 major potential catalysts for Alphabet in 2024, and those are advertising and artificial intelligence. With the Google search engine and YouTube, Alphabet's revenue streams are derived from ad sales. In 2022 and the first part of 2023, companies weren't investing into advertising due to the economic outlook. However, in the third quarter of 2023, Alphabet's ad revenue rose 9%, which is a significant improvement from past few quarters. Alphabet also announced the latest iteration of its Gemini generative AI model, which has received mixed marks at the beginning, but I believe they will only improve from here on out. While it may be some time before Alphabet monetizes it, the advancement made in 2023 will help push the stock price higher in 2024. Now, let us look at some metrics for Alphabet. As the majority of other tech stocks in the market, Alphabet has had a great 2023 year. Year to date, Alphabet is up around 60%. It is trading at a PE ratio of 26.66 and has a forward PE of 21.4. This PE gives us an earnings yield of 3.75%. Alphabet doesn't pay any dividends, therefore there is no yield and no payout ratio to be considered. Next, the price to free cash flow is at 22.92, which gives us a free cash flow yield of 4.36%. This is still above the 10-year bond yield of 4%. Now, let us look at the discounted cash flow analysis for Alphabet. Here, we will use metric of free cash flow. Number of years to project is 5 years. We will use the annual free cash flow growth rate for the past 5 years, which is at 27.73%. Alphabet has been doing share buybacks at the rate of 2% over the last 5 years, and the price ratio for the free cash flow has been around 26.44 over the past 5 years. As usual, we will take the discount rate of 10%, and with all of these inputs, we can see that the fair value is at $382 or 167% above the current price. The future stock price is projected to be at $615 or 331% above the current stock price. If these metrics were hit in the future, then the compounded annual growth rate for Alphabet stock would be at 34%. Again, even here, if you would apply a margin of safety of 50%, then the stock would still be growing at 17% annually. Next, coming in at number 2 is Amazon. Amazon margins have dramatically improved throughout 2023 due to its efficiency efforts, and Amazon even became free cash flow positive in the third quarter of 2023. With its margins nearing all-time highs, Amazon appears likely to have a great 2024 if they can maintain those margins, and I believe that they will be able to do this. On top of that, Amazon's revenue rose 13% in the third quarter of 2023. This growth rate was despite its Amazon Web Services cloud computing business not having a strong year. With the rise of artificial intelligence AWS should be in demand again, which should be another catalyst for Amazon to have a great 2024. Now let us take a look at some of Amazon's metrics. Amazon has also had a great 2023 and the stock is up almost 80% year to date. Amazon trades at a high PE of almost 79, however the forward PE is at 45. The PE of trailing 12 months gives us an earnings yield of 1.27. Amazon doesn't pay any dividend, therefore there is no dividend yield nor payout ratio to consider. The price to free cash flow is very high, which is almost 94, which gives us a free cash flow yield at 1%. Now, on paper, this doesn't look very cheap, as we know that there should be a margin of safety between the 10-year bond yield, which is 4%, and a free cash flow yield. However, for Amazon, this is not the case. The reason for this is that Amazon's share price is following their operating cash flow, not the free cash flow. Therefore, for the discounted cash flow analysis for Amazon, we will be using the operating cash flow metric. Here we can see that if we project the operating cash flow metric for 5 years and the growth rate of above 18%, we apply the share outstanding growth rate, which was 1% share dilution over the past 5 years. The average price to operating cash flow over the last 5 years is at 26.34, and we apply the same price ratio. The discount rate is at 10%, and with taking all of these inputs into account, Amazon's fair value is at $250 or 63% above the current price. The future stock price is projected to be at 403% or 163% above the current price. If Amazon were to hit all these metrics, then the compounded annual growth rate for Amazon would be above 21%. Here again, you could take a margin of safety of 30%, and Amazon will still be outperforming the broader stock market next year. Last but not least, coming in at number 1 is no other than NVDA. I know, shocker. However, the growth of this company seems surreal to me. I have never seen this before in my life. NVIDIA's revenue went up from 6 billion in Q3 2022 to 18 billion in Q3 2023. This is a growth rate of over 200% on a year-over-year basis. This is of course all thanks to the AI frenzy, which has been going on for the whole year of 2023. Seriously, every company that has uttered the initials AI in their earnings call has had their stock share price jump by 10% in after hours trading. Even if the company was a toilet paper producing company, it did not matter. As long as they mentioned the words artificial intelligence, their stock price is going up. But I digress. NVIDIA has positioned itself at the forefront of AI race. It does not matter who wins the AI race, as long as NVIDIA is at the forefront and is supplying the chips for AI, they're gonna do great numbers. Now let us take a look at some metrics for NVIDIA. NVIDIA had an amazing 2023. Year to date, the stock price is up by 241%. The company is trading at a PE ratio of 63 for the trailing 12 months, and the forward PE is 27. The trailing 12 months PE of 63.86 is giving us an earnings yield of 1.57. The dividend yield is at 0.03%, which is around 16 cents per share, and the payout ratio is at 2%, which is very much negligible. The price to free cash flow is at 68.86, which gives us a free cash flow yield of 1.45. Very similar to Amazon, on a free cash flow yield basis, NVIDIA also doesn't satisfy the risk premium ratio because it's traded at 1.45%. However, let us still look at the discounted cash flow analysis for NVIDIA, and we will use the metric of free cash flow again. We will project the number of years at 5 years. The annual free cash flow growth rate for the past 5 years for NVIDIA has been 41%. The shares over the last 5 years have been basically flat. The price ratio, as we saw, is 68. And we will use a discount rate of 10% again. If we take all these inputs into account, then the fair value of NVIDIA stock price is $1,672, 242% above current stock price. The future stock price is projected to be at $2,692 or 451% above the current stock price. If all these metrics were to hit, this would mean that NVIDIA will be growing at a compounded annual growth rate of 40%. Here we can again apply a 50% margin of safety and say NVIDIA is going to hit their metrics by half, and still NVIDIA should be growing at 20% where the average stock market is growing at 10%. And that's it for today. Those were my 5 stock picks which I believe will outperform the stock market in 2024, and I explained you why. If you find this video helpful and if you want to follow my stock portfolio in real time, then please hit that like button, subscribe to our channel, and let me know down in the comment section below what is your top pick for 2024. Also, in case you're interested in a fuller review of my stock portfolio, then go check out my December stock portfolio update video. The link is in the description of this video. Thank you so much for watching. I hope you enjoyed it, and I'll see you in my next video.